Do you feel that tension in the air? A strange, heavy silence that has descended upon the cryptocurrency market. It's a silence that feels deceptive. While retail investors nervously watch the daily charts, getting shaken out by minor fluctuations, a much larger, almost imperceptible movement is happening in the deep waters of the market. A strategic repositioning of billions of dollars is taking place, far from the public eye. In the last 5 days, crucial pieces of a complex puzzle have been moved by unseen hands. On one side, we have a corporate titan doubling down on a multi-billion-dollar bet, acting with a conviction that borders on prophetic. On the other, the most powerful government in the world wields its economic policy like a weapon, with the potential to stifle any rally before it begins. And caught in the middle of this high-stakes game is a silent exodus of coins from exchanges, a phenomenon that has historically preceded the most explosive price movements. Stay with me until the end of this video. We will not just look at the headlines, we will dissect them. We will connect the dots between corporate strategy, macroeconomic pressure, secret on-chain data, and rising global instability to reveal what these signals truly mean for the future of your wealth. The truth is never on the surface. Let's begin with the unwavering titan of Bitcoin, MicroStrategy. While the market was painted red and fear was the dominant emotion, Michael Sayllor did what he always does. He didn't just hold, he bought more. This week, MicroStrategy announced the acquisition of another 11,931 bitcoins, purchased for $786 million. This brings their corporate treasury to an almost unbelievable 226,331 bitcoins. To put that in perspective, that's more than 1% of all the Bitcoin that will ever exist. But to understand the gravity of this, you must understand Sayllor's philosophy. He doesn't view Bitcoin as a speculative asset, he sees it as the dawn of a new form of property. Digital property, an incorruptible hedge against the inevitable devaluation of all fiat currencies. He is not trying to time the market, he is trying to exit a broken system. Each purchase is a calculated move to convert the company's balance sheet from a depreciating asset, cash, into what he believes is the world's most reliable store of value. This recent purchase, made at an average price of around $65,880, reinforces his long-term strategy. It's a deafening signal to Wall Street and the world. Sayllor is systematically removing a vast supply of Bitcoin from the open market, locking it away in a digital vault for years, if not decades. Every coin MicroStrategy buys is a coin that cannot be bought by you, me, or a future Wall Street ETF. It's a nearly $15 billion bet that the future of Bitcoin is not just slightly higher, but orders of magnitude greater than today. The question that should keep you awake at night is, what information, what conviction, drives a man to make such a monumental bet against the entire global financial establishment? But this bullish conviction runs headfirst into a powerful wall, the U.S. Federal Reserve. While Sayllor builds his digital fortress, the Fed threatens to starve the kingdom of capital. This week's economic data was a classic good news, bad news scenario. Inflation showed a minor cooling, which should be positive for risk assets. But the statements from Fed officials were a cold shower. They spoke of a long, drawn-out fight, signaling that the high interest rates crippling the economy are here to stay. Let's be clear about what this means. High interest rates are like a gravitational pull on assets like crypto. They increase the appeal of safe, boring government bonds, pulling money away from the speculative and volatile crypto markets. The era of easy money from 2021, which fueled that legendary bull run, is a distant memory. The crypto market is now in a trial by fire, forced to prove it can thrive based on its own merits, adoption, technology, and scarcity, not on a flood of cheap government-printed cash. And this economic pressure is now amplified by a darker cloud on the horizon, geopolitical instability. We are living in an increasingly fragmented world. Tensions in Eastern Europe remain high, and new frictions in the South China Sea are causing jitters across global supply chains. These are not just distant headlines, they have a direct impact on your portfolio. In moments of escalating conflict, institutional money initiates a flight to safety. Capital is pulled indiscriminately from anything considered risky, which includes both tech stocks and crypto, and is moved into traditional safe havens like the US dollar. This is a powerful force that can trigger sharp, sudden market downturns, regardless of any bullish fundamentals. However, this instability has a fascinating dual effect on Bitcoin. While it may cause short-term price drops, it simultaneously strengthens its core long-term narrative. For citizens living in regions with unstable governments, collapsing local currencies, or strict capital controls, Bitcoin represents something else entirely, a lifeline. It is a non-sovereign, censorship-resistant asset that cannot be arbitrarily seized or devalued by a single power. It's a tool for financial survival. So, as global instability rises, the fundamental need for an asset like Bitcoin also grows. This complex global picture extends to regulation. The German government's recent sale of confiscated assets was a reminder of state power, but it's just one piece of a global patchwork of rules. While the United States continues its slow, often confusing regulatory dance with the SEC, other parts of the world are moving decisively. Hubs like Hong Kong and Dubai have embraced digital assets, launching their own ETFs and creating clear legal frameworks to attract talent and capital. This creates a competitive dynamic where capital and innovation will flow to regions that offer clarity and support, while regulatory uncertainty in one nation can push development to another. This global fragmentation is a major trend to watch. But let's return to the blockchain itself, for the most powerful story is the one written in code. The on-chain data is revealing a trend so significant it cannot be overstated: a massive, silent exodus of Bitcoin from all major exchanges. The total balance of Bitcoin available on exchanges has plummeted to its lowest level in over 6 years. This is not a minor fluctuation, it is a seismic shift in supply dynamics. Smart money, the long-term holders, the entities known as whales, are aggressively pulling their assets into cold storage. This is the clearest signal that they have no intention of selling. They are preparing for a future where Bitcoin is much scarcer and far more valuable. This action creates a supply shock. As the available supply dwindles, any increase in demand will have a dramatically amplified effect on the price. And the catalyst for that demand may be just around the corner. It has a name: Ethereum. The anticipation for the spot Ethereum ETFs in the United States has reached a fever pitch. With the first major hurdle cleared, all eyes are on the SEC to finalize the S1 registrations, with top analysts predicting a launch as early as the first weeks of July. Remember the market's reaction when the Bitcoin ETFs went live. A fire hose of institutional capital was turned on. Now apply that same mechanism to Ethereum, the foundation of decentralized finance. It's a stamp of approval from the traditional financial world, with analysts predicting inflows in the billions. Yet, while the giants of Bitcoin and Ethereum dominate the headlines, innovation elsewhere in the crypto space is accelerating. A powerful new narrative is emerging at the intersection of artificial intelligence and blockchain. Projects are now building decentralized networks for AI computation, aiming to break the dominance of big tech and create more open and accessible artificial intelligence. This, along with the tokenization of real-world assets, RWAs, represents the next frontier, turning illiquid assets like real estate or private equity into tradable tokens on a blockchain. These are not just curiosities, they are the seeds of the next multi-trillion-dollar markets. So, let's connect all the pieces. We have MicroStrategy's unshakable conviction. The oppressive pressure of the Fed, now compounded by the threat of global instability. A historic supply shock building on-chain. The imminent catalyst of the Ethereum ETFs. And below the surface, new waves of innovation in AI and asset tokenization are preparing to emerge. We are not watching random events. We are witnessing the setup for a new market paradigm. A quiet, tense battle between unstoppable technological adoption and the immense forces of the old financial world. The calm we are experiencing now is deceptive. It is either the moment of greatest opportunity for those who understand the game, or the final, silent warning before a storm of extreme volatility. The game is just beginning.